You look at these assets, you say, okay, they're very volatile. Well, that's on the upside. They can only go to zero. The volatility actually is positively correlated with the price, which is quite often the opposite of what we see in traditional assets, where volatility spikes. It's quite often that the price of the asset is going down.
Hey, welcome to Decoding Crypto with me and Ryan Grace, head of Tasty Crypto, all the way from Chicago. Hey, Ryan, how's it going?
Hey, Angeline, I'm doing well. How are you doing?
Yeah, good. You're looking dapper in that jacket there.
Oh, thank you. I've spruced it up for episode 2 here.
Nice. Episode 2, and we talked about what is crypto, helping our trader friends understand the basics. Now we delve a bit deeper into that V word, volatility. Just take us through how volatile crypto is compared to, for example, stocks and shares. That's considered, having a wide range of volatility. Of course, bonds, by contrast, considered, to be lower volatility. How does crypto sit in all that?
Yeah, absolutely. So when you think about the risk spectrum and you think about volatility from that perspective, I would put crypto, or let's say Bitcoin, for example, in the same bucket as a lot of high beta tech stocks. Now, if you look at the life cycle of Bitcoin, of the crypto industry, you've had a lot of volatility at certain points in time, no different than bouts of volatility that you see in traditional markets. But over time, crypto has become less volatile. That's a function of more liquidity, more participation, more awareness, and more risk management in the space versus where we were, let's say, 10 years ago. So you've seen the volatility come down over time in terms of the peak in vol on a yearly basis. At one point, we were used to Bitcoin volatility well above 100% annualized. Today, on my screens, I have an implied volatility of Bitcoin of right around 40% on a 30-day basis, and the realized or actual volatility for Bitcoin on a 1-month period is right around 30%. Now, these are some of the lowest levels we've seen this year, but for context, you can compare that to the implied volatility currently of Tesla. That's about 70%. So when you look at this versus a lot of the popular tech names, the Mag 7, it's at times as volatile, if not a little bit more, but often many times it's less volatile. So I want to dispel the myth that this is an extremely volatile asset. It can have bouts of volatility like anything else, but generally speaking, its volatility has come down quite a bit over time.
And let's talk about risk reward too, because we have many people asking about what is there a formula? And Ryan, some people asking whether or not there is a straightforward calculation, or is this really down to each person's risk appetite?
I think it's really down to your risk appetite, but what's unique about this asset is its asymmetry at this stage of its life cycle. At some point, that market becomes saturated with participants, but it's still relatively early stage, and we've talked about it being relatively early stage for adoption. As a result, you have some asymmetry that's embedded in this asset class, and what I mean by that is that the reward quite often is a multiple of the risk. We know what the risk is. It can go to zero. We've seen significant drawdowns over the course of history. So in 2014, about 60% drawdown. 2018, we had the ICO bubble and then the subsequent crash, about a 70% drawdown. 2022, we had the FTX exchange debacle. We had the subsequent collapse in the industry, and we saw about a 60% drawdown. So the drawdowns, while significant, have become smaller in size, but you still have points in time where the upside is, again, 2-3x what those drawdowns have been. So for context, you look at the average annual return of Bitcoin over the last decade, it's 84%. If you look at 2024, what did it do just in total? Last year, went up 120%. Currently, on a one-year basis, if you look back on a rolling one-year period, we're up about 56%. So you have, in many cases, a lot more upside with Bitcoin. Bitcoin's a bit more mature. If you go further out on that risk spectrum, you look at things like Ethereum, Solana, arguably there, at least historically, has been more upside and actually more volatility. We talk about the risk. You look at these assets, you say, okay, they're very volatile. Well, that's on the upside. They can only go to zero. The volatility actually is positively correlated with the price, which is quite often the opposite of what we see in traditional assets, where volatility spikes. It's quite often that the price of the asset is going down. Not so much the case here with cryptocurrencies, with Bitcoin.
Right.
And so when you think about how you trade that and risk management, sure, you can have some formula and you can come in here and you can say, I'm going to put this trade on and I want a 10% gain and I'm going to cut my losses at a 5% loss. Maybe. I personally, in my opinion, think that you want to try to take advantage of that asymmetric upside. That's the reason you might want a small allocation to this asset. So within your portfolio, because of that upside volatility, a little bit goes a long way. So you don't have to have a huge position to benefit from some of that asymmetry and that convexity that exists in Bitcoin.
So some, on that note, are asking whether or not it should be a, drip feed strategy, put a little bit in at a time rather than a big chunk in.
Yeah, I think that's definitely one way to approach it. You can dollar cost average in, or in this case, pound cost average in. I'm here in the US, so dollar centric. But given nobody knows what's going to happen in the future, right? And at times it has been very volatile. That's one way to approach it. We were at $75,000 per Bitcoin at the beginning of April. We're here near or at an all-time high at the time of recording of about $110,000 in Bitcoin. And so because you have no idea what it's going to do, and it can move very, very quickly, if you're looking to invest in this over time, you have a multi-year time horizon, then maybe a dollar cost averaging or a drip kind of approach to the market makes sense.
Right. I know your time is short. You're a very busy man. Just wanting to cover some of the market risks and the landscape out there, especially regulation as well. Of course, we had, some big name scandals recently. You already mentioned FTX, but there was also Bybit and, of course, OneCoin as well. What are the risks going forward? Not just tech, but also human.
Yeah, I think when you look back throughout history, I mean, there have been a lot of exchanges that have been hacked. Arguably, as those things occur, that makes the system more durable. You learn from that. There's kind of this degree of anti-fragility in some ways. You see that in the traditional financial system as well, right? We've gone through periods where bad things have happened, and then as a result of that, we see regulations that are formed, and we fix those problems we learn from those mistakes. I think you're seeing the same thing here in the crypto industry. So regulation is coming. Unfortunately for crypto, what happened in the United States post FTX was really the weaponization of government agencies against the industry in response to what happened with FTX. What happened with FTX was, let's be frank, the people running that exchange were committing fraud. They were misusing customer funds in ways that there are protections that exist to protect consumers against that in the traditional system that aren't necessarily in place in all jurisdictions here in the crypto industry. But that's changing. So there's always going to be some risk associated with that, but I think that we're going to get farther away from it. And what you're really going to have to more so worry about are the same risks that exist when you invest in any other asset class. And those are specific to the underlying position that you hold, the leverage that's embedded in it, and then what drives that market on the margin. We can speak to that in a second. But on the regulatory front, I think that's actually one of the most bullish developments, because this has been an environment where a lot of institutional participants have been sidelined, and that capital that we're looking to really come in and in some ways influence price action here hasn't participated in the market. So what's happening in the US, at least, is a stable coin bill that's making its way through Congress. And then following that, assuming that we see that pass, we should have a crypto market structure bill here, which then gives everyone that is waiting for a regulatory framework a set of rules they can adhere to so that they can then participate. And I would imagine that you then see big banks, larger financial services companies that have yet to really be in this space, they start to participate. And I think that improves liquidity and maybe mitigates risks for everybody over time, right? I mean,
it's
here
super
today,
exciting. We're kind of looking across the pond, waiting for a date for when that is all going to happen. Is there a clear date yet?
The best sense that we have from talking to certain people in the industry and actually, hearing from people in Congress themselves is that they're very hopeful we get something done by the end of the summer. So let's say by the end of August, whether that's the full spectrum of stablecoin legislation and crypto market regulation, we'll see. But I think that you'll get something, which is encouraging.
Right. Thanks very much. We're going to leave it there. Ryan Grace from Tasty Crypto from Chicago. Looking forward to having you on the third in the series where we delve more into regulation and how that's transforming the industry.
Thanks for having me.